Hey, Steve Saretsky here. Welcome back to the show. Lots to touch on this week. Of course, we've got an update from the Bank of Canada. We've got some updates on mortgage loan growth, household loan growth, how that's playing into the system. And then I'm going to walk you through why I believe housing affordability is still going to be a topic of discussion 10 years from now, because it's playing out exactly as we've been highlighting on this channel for the last 6, 12, 18 months, is the failings of all three political systems here in Canada. So I'm going to walk you through that. But of course, we have to talk first and foremost about the Bank of Canada. If you're watching this video, this channel last week, we made the call that the Bank of Canada would not raise rates. Again, not a hard call to make, pretty consensus. If you really think about it, again, 500 basis points of tightening. You can see the Canadian economy is slowing rather significantly, and this is with lagging data. So again, using sort of more forward-looking indicators, which I think is a lot of the time you can just look at housing, given the size of the impact it has on the Canadian economy, that as housing slows, the rest of the economy will follow suit. So really not that hard to see why. Now, the Bank of Canada flagged a couple things, which again, we've been talking about on this channel for quite some time, which is the long end of the yield curve, aka rising bond yields, is doing most of the tightening for central bank, particularly the Bank of Canada, right? You don't necessarily have to raise interest rates if bond yields continue to push higher, aka the mortgage rates push higher, and the cost of borrowing becomes more and more expensive, right? I mean, the cost of borrowing a 3-year or 4-year or 5-year fixed mortgage has been going up and up and up and up over the last 2 months. And that has nothing to do with the Bank of Canada. It's just simply the bond market pushing yields higher. So again, the bond market is doing the financial tightening for the Bank of Canada. And that's the Bank of Canada has flagged as one of the, basically part of the reason why they felt it was necessary to keep rates on hold and not raise further. Now, they talk about the path, the narrow path to a soft landing is getting narrower, and that's their words, not my words. And again, that really should not come as a surprise if you look at the state of the economy. Again, we're seeing retail sales declining in real terms. GDP probably going to have another second consecutive contraction here coming up. So again, the interest rates are working their way through the system. Now, it's funny because somebody asked me this this week, which is like, hey, where do you think housing is next spring? And the reality is I don't really know. A lot of it just depends on where rates are 3, 4, 5, 6 months from now. But I think people have a short memory, which is like, there's a real possibility this housing slump could prolong into a year, another 2 years. It could go on 3 years. We have no idea. But like, the reality is housing peaked in February of 2022. We started hiking in March of 2022. It hasn't even been 2 years. It hasn't even been 2 years since since the housing market peaked. Sometimes housing drawdowns last 3, 4, 5 years. Sometimes you go to flat markets for 10 years. Imagine 10 years of basically no real house price growth. That remains a realistic possibility. So I think everybody sort of has these short time frames because everyone's just waiting for things to sort of bounce back. Now, again, looking at the Bank of Canada, there's a couple of things that I would flag to you as real concerns moving forward. Remember, this is a credit-based financial system, right? You need credit to grow the economy. It's a debt-based system. That's just how it is. It's not right or wrong. It's just what it is. And so right now in Canada, you got household loan growth running at its lowest levels since 1983. So there's virtually little to no growth in household loans. Basically, you have people that are trying to actually pay down debt. They're deleveraging, and that, I think, in of itself is a demand killer and actually disinflationary. Again, if you want to support high house prices, right? So if house prices become very expensive, you need to take on more leverage and more debt to support the valuations, right? I mean, how do you afford a house today? Well, you got to borrow a lot of money, and you need more and more mortgages entering the system to sort of help support the valuations. And so right now, you've got mortgage loan growth running at its lowest levels since 2001. So it just really shouldn't come as a surprise that the outlook for house prices, if you've got mortgage loan growth running at its lowest levels in over 2 decades, that naturally you're going to see a contraction in house prices. And that's exactly how things are playing out. And again, I would argue that we've had some bounces along the way, but the reality is that rates at these levels are restrictive enough to hit demand, given the leverage and the magnitude of house prices that are in the system. And so this is, I think, ultimately why the Bank of Canada, again, is on the sidelines. I think it's going to remain on the sidelines. Yes, they talk a big game, because they can't come out and say, hey guys, the economy really stinks and we were forecasting rate cuts in early 2024, mid 2020. They can't come out and say. They have to continue to act tough because they can't unleash the animal spirits in the market. Saying, again, so much of inflation and markets and people's decision making is psychological, right? Again, if you believe that rates are going to remain high and you believe the outlook for housing looks weak and could get weaker, you're going to delay that decision. And so this is exactly what the Bank of Canada needs to do. I think they're basically jawboning the markets at this point. They know that households can't really take any more pain in terms of higher interest rates, and so we got to continue to look and act tough. But in reality, again, I think that they're done on the interest rate front. So we'll continue to monitor that. Again, data can possibly change 2, 3, 4, 5 months from now, but I think that the course is towards a contraction, a steeper contraction in the Canadian economy. But that brings me full circle, which is this thesis that we've been talking about on this channel for quite some time, which is we've had a tremendous bull market. Money's been cheap for a while. There's definitely been a lot of malinvestment, and but those low rates have definitely helped spur a lot of new housing construction. We've seen that. You got housing units under construction. I believe at all-time record highs right now. And again, now as rates go up, right? 500 basis points tightening from the Bank of Canada, naturally that's going to destroy the economic feasibility of a lot of new housing construction. And so this is, of course, a bit of a challenge when you say, well, you're the government that's importing 1 million new people into the country a year, record immigration growth, that's hell-bent. Clearly I think we have structural shortage in housing. Yes, interest rates are going to bring house prices down, but the reality is you still have a structural shortage in homes available. It's pretty obvious. You look at the rental market. The rental market's a function of supply and demand. Rent's growing still today at double digits. I think shows to you that there's a structural imbalance of housing supply. So governments are trying to ramp up housing supply, but pretty hard to do when rates are moving up and the cost of capital ultimately crushes the viability of these projects, right? Developers have capital partners they need to pay, and when the risk-free rate is 5%, it's no longer zero, your hurdle rate, the capital that these investors are going to demand, for example, is naturally going to be higher. So we've been talking about this for a while, despite what the federal government says. The housing minister, who was previously the immigration guy, says he's going to get housing starts ramped up. It's just not going to happen. And so we're seeing this. In fact, the residential, so adjusted for inflation, real residential investment in construction in this country is at its lowest levels since 2011. So again, the investment in new housing is starting to roll over and is collapsing. At the same time, we found out this week, we had the immigration minister, the new guy, Mark Miller, saying, he looked at it, he thought about it, but he's not going to cap the number of international students coming into this country. Can't do that. So, we're going to continue full steam ahead. The immigration targets are going to stay the same. We're not going to set a cap on international students. So the floodgates will remain open. However many people come here is how many people are going to come here, and we'll just have to figure it out. So this is happening. at the same time, again, as housing investment is collapsing. And then we found out this week the the region of Metro Vancouver. So basically, all the municipalities essentially pool funds in together to upgrade sewer and infrastructure across the Metro Vancouver. And so there's been a lot of debate going back and forth about they need to raise money. The municipalities are struggling right now. A lot of them are having to raise property taxes to fulfill their budget requirements, right? We've talked about the city of Vancouver, for example, is talking about I believe it's 9% annual property tax increases over the next 3 to 5 years. And don't quote me on the number. It's something large in that scale. And so they're struggling there. Like, well, where can we raise taxes? How can we get more taxes? And so someone's got to pay for the infrastructure growth. And so what they've decided to do is they've decided to do that by raising development fees, development cost charges is what they're called. And they just voted to triple them. They're going to triple the development cost charges starting in 2025. And so what that's going to do, it's going to add about $15,000 per condo unit, for example, basically per unit. And not a perfect number, but you look at the numbers, look at the math, it's going to add about $15,000 to each individual housing unit in this region. And so you go, okay, so residential investments collapsing. People are, the economic viability of development is no longer viable in many, many circumstances. The federal government has done their best. Well, not really, but kind of. They tried to removed GST on new rentals more recently and said, okay, like, we can see this is happening. So what we're going to do is we're going to remove GST on new purpose-built rental housing, 5% savings to the developer. But yet the municipalities turn around and says, well, okay, that's great. It's awesome that you guys have done that, but we're going to actually triple our development cost charges because we need the tax revenues. So again, in order to get the housing channel to work together, you need the federal government to work with the provincial government and the provincial and federal government to work with the municipal governments. And so not everybody is clearly coming together. And then, of course, you layer that on top and you've got central bank policy, particularly the Bank of Canada, who is not working in unison either because they are trying to kill demand and investment to bring inflation down. And so seeing housing starts rolling over is arguably it's what they want to see. It's what they need to see to get inflation down and back to target. So this is the issue, is that you've got this really complicated housing file and you need all these levels of policymakers to work in unison, but they all clearly have different outcomes and objectives. So we're going to continue to go around in this circle and everyone's going to point fingers, and we've got a couple elections coming up and we've seen the federal government, of course, trying to make all these big splashes because the election is around the corner. The polls really stink. But the reality is nothing's going to change. We're going to enter an economic downturn, which we're already in. It's probably going to deepen, which I think ultimately ends up impacting and hurting their polling numbers even further. Housing prices will probably continue to go lower. They'll grind lower, not because you have an oversupply of housing, but because interest rates at 6% is all that matters in the very near term. The numbers simply don't work for the current environment. And so that's going to choke off new housing supply moving forward. It won't necessarily be an issue today or 12 months or 18 or 24 months from now. But when we're talking about over longer term periods, I'm talking 5-10 years from now, you're going to see the impact of the housing supply channel being choked off as it has been over the last 6 months, and how it's going to continue to get choked over the coming 6 to 12 months, because it's happening and it's real. So as always, I hope that helped. I know it's kind of a bit of a dark message. It is a little bit depressing at times, but this is the nature of markets. You and I don't get to dictate the terms; we're simply living in them, and hopefully you can position accordingly, however that may be given your circumstances. But that's the reality. So fade all of the political noise and discussions, and whether it's Tiff Macklem at the BOC or it's Sean Fraser, the housing minister. Fade all the noise and just focus on the facts, which the facts I think we've laid out quite well here. So as always, hope that helped. We'll see you next week.